Thank you very much for the presentations once again and the participation here. We are so pleased to have with us as keynote speaker Patrick Harker, who is the 11th President and the Chief Executive Officer of the Federal Reserve Bank of Philadelphia. With a distinguished career in academia, I'm very pleased to say that I had more or less a small parallel path with Patrick, as he served as Dean of the Wharton School of Business since 2000. And I served the Lebeau College of Business during the period of time. And if you remember, Pat, it was the time when you hosted me to show me the beautiful building that we had. And now here you are in our beautiful building that we built after the visit, I would say, which was very inspiring. And thank you for your hospitality. But President Harker has a distinguished career, a very long list of accomplishments I will go through very quickly. He served as a professor at the Wharton School of Business for a number of years. He was appointed as the youngest ever professor, endowed professor at the Wharton School of Business, and then since 2000 until 2007 served as a Wharton Dean, and then transitioned being the president of the University of Delaware. And then in 2015, he was appointed as the president of the Philly Fed. I can tell you he has served on many boards and non-for-profit organizations, but one of the common elements of his leadership has been to serve the constituency that he represented. And he has served very well the constituency, the our academic world, the students, but also our area here in the Philadelphia area, where, as I understand, the key elements of economic growth are part of his incredible leadership efforts. With this, I would like to ask him to come to the podium to give us an update on the economic developments in the United States. As we know that he serves on the Federal Open Market Committee, where key decisions about interest rates are made, and I'm sure he will tell us something about when the interest rates will come up. Thank you.
Well, good morning, everyone. George, thank you so much for that kind introduction. So the tagline of this conference, as you know, is Global Trade, Darkening Clouds, or New Beginnings. And I want you to know I valiantly resisted the temptation to make a bad joke, or even worse, a pun, involving Churchill's beginning of the end, or the end of the beginning. But there are some echoes of its essence in the subject of my remarks today. Life and policy is full of endings and beginnings that are part of a larger whole. So I'd like to talk today about the continuing process in the United States of normalizing monetary policy and the unwinding, and part of that is the unwinding of the Fed's balance sheet. While this topic is not directly related to the topic of this conference, it has received a significant amount of interest both here and abroad. So I thought I'd bring you up to speed on where we are. So if I were to give in to that urge to make that joke, I might call it the beginning of the end, of the middle, of the end, of the almost end of our road to normal. But of course, I would never, ever do that. I will, however, add to my remarks a brief outlook before I start on the balance sheet, of where I see the economy, how it's unfolding, and what that means for my policy views going forward. So I am approaching this summer my 4-year anniversary as the president of Philly Fed. And one of my first lessons, one of the first things I learned on taking that seat was everybody always wants to get to the bottom line, the economic outlook, and at least where we think rates are going. Another thing I learned very early on is to preface any remarks I make with the standard Fed disclaimer: my remarks today are mine alone and do not reflect anyone else in the Federal Reserve System or the Federal Open Market Committee. You are my witnesses, I cannot get in trouble. So, let's start with GDP. The initial readings of Q1 were a pleasant surprise, particularly as first quarters have tended to be slow in recent years. In fact, we have we believe, some measurement issues in Q1. So this was really a surprise. However, there are a few caveats. A good chunk of that boost came from inventories and net exports, which are unlikely to carry through the rest of the year. It's possible that the drag we usually see in the first quarters will show up in Q2 this year, as inventories in particular tend to counter large boosts today with a drag tomorrow. Consumer spending, which has been the primary driver of growth, showed a slowdown from last year, as did business investment. These are the worrying signs in that very good number. The net result of these two components means my outlook for growth this year remains pretty much where I was for the last several quarters, or last year. A little above 2% for this year, GDP growth. I also continue to see next year returning to trend, and trend growth is 2%. The labor market continues to show remarkable strength, and truly remarkable strength, with strong job creation and low unemployment. And I think the unemployment rate will move down a bit more, probably to around, our estimate is around 3.5%, before edging back up a few tenths of a percentage point over the course of the year and next year. Inflation has softened, though, in recent months, and it's an area I'm focusing my attention on. I have not yet revised my medium-term inflation forecast because I suspect that some of the recent weakness is transitory. So I still see inflation running slightly above our 2% target for the medium term, but that projection is nowhere written in stone. It's more like a dry erase board that you find in these buildings. I mean, we have to really watch and be very careful. So because if any component of the outlook were to affect my views on the appropriate path of monetary policy, it would be inflation. However, we're not there yet, and it would take more data to convince me to do anything and veer from my current policy path. I therefore continue to see one increase at most this year, 25 basis point increase at most, and we'll have to wait and see how that plays out. And again, at most, one more next year. And again, this is all taken with many grains of salt as we watch the economy evolve. So let's turn to the crux of my remarks today, the balance sheet. As you know, the FOMC has made further moves regarding our balance sheet, which were laid out in its updates to the normalization principles and plans after our January and March meetings. There are three interrelated components to this balance sheet issue. First, continued implementation of monetary policy in a regime of ample reserves. Second, our intent to stop asset redemptions in September. And third, the anticipation that the size of our balance sheet will be constant for some time after that, letting the supply of reserves decline very gradually as currency and other non-reserve liabilities grow. So let me clarify some Fed speak. Monetary policy in a regime of ample reserves. What that means is that policy will be executed as it is in normal times, with the Fed funds rate acting as our primary tool of monetary policy. The Fed funds, along with other short-term rates, will be managed mainly via administered rates, such as interest on reserves and the overnight reverse repo rate. Amplitude, of course, can sound quite nebulous, but in the case of the Fed funds market, an ample supply of reserves has a very specific meaning. A level of aggregate reserves that can comfortably accommodate demand within our target range through all the volatility associated with seasonal demand and autonomous factors without requiring, this is the key point, active management. This means that as long as the economic and financial conditions unfold more or less as we expect them to, the balance sheet will remain largely on autopilot, left in the background, and hopefully as boring as ever. While the current state of reserves certainly falls within that definition, the committee also has made clear that we ultimately intend to hold no more reserves than necessary for efficient and effective monetary policy. Now, I'm going to revisit that expression quite a few times, so it's probably best if everyone adds mental quotation marks around no more than necessary and efficient and effective. I promise it reflects my adherence to careful policy wording rather than a lack of imagination or a thesaurus. So, as we announced, our plan is to end the balance sheet runoff in September. Starting this month, the cap on Treasury redemptions will be lowered from $30 billion a month to $15 billion, to put a modest damper on the pace of redemptions. When the runoff ends, reserves will likely still be somewhat more than necessary for that efficient and effective execution, rather than no more than necessary. Therefore, we intend to hold the size of the balance sheet roughly constant for a while. By doing so, we will let the supply of reserves decline gradually with the growth of currency and other non-reserve liabilities. So for me, a key issue is that we only have estimates of the demand for reserves, and that uncertainty calls for a cautious approach. It may be, and it very well may be, that ample is more than we thought, and reserve levels can't really drop much further without inflicting interest rate volatility and creating liquidity management issues for financial institutions. Additionally, the supply of reserves is notoriously volatile. Autonomous factors such as the Treasury General Account and repo facilities can move the aggregate supply of reserves by as much as $90 billion in either direction in a single week. Now, we have a good track record of forecasting these swings, and they do tend to reverse themselves. But those factors do inflict a substantial fluctuation in the supply of reserves to depository institutions. So, in metaphorical terms, it is a dark and stormy night, to quote Peanuts, and we are walking in the direction of a wall. We're walking in the direction of this wall where we're going to see the elasticity of demand for reserves increase. In that situation, most of us would give the advice of walk, don't run, and keep a bit of distance from where we think that wall is. So we intend to walk toward that efficient and effective level rather than charging at full speed. The plan is to slow down the pace of decline in average reserves. We'll do that by keeping the size of our aggregate security holdings constant for a time. During this period, we will see a very, and I do stress very, gradual decrease in average reserves as currency and other non-reserve liabilities grow over time. Average currency growth, for example, rarely exceeds $10 billion per month, while asset redemptions have averaged more than $30 billion a month. That said, more than half of the decline realized to date in our balance sheet was unrelated to asset redemptions, and reserves have declined by more than $1 trillion since their peak of $2.8 trillion. This slow and steady approach, which is actually based on work by the folks in the Philadelphia staff, is not only the safer option, it has the additional advantage of reducing uncertainty about the evolution of asset redemptions. In fact, it effectively decouples asset and liability policies as we make our way to this position of no more than necessary. It also gives us, and I think it's very important, additional time for monitoring and analysis, and may even foster changes to how financial institutions manage liquidity. These factors both meet the FOMC's stated objective to proceed in a gradual and predictable manner. Now, we also want to keep a comfortable distance to avoid a collision with this wall. As I said, we only have estimates of the demand for reserves, and the parameters of ample may be closer than we think. These autonomous factors I mentioned add something of a howling wind to our metaphorical late-night excursion, because their volatile effect makes it similarly difficult to navigate a narrow path for aggregate reserves. Both considerations call for additional aggregate reserves, creating a sort of buffer zone, right, to account for margins of error in our estimates and protect against large swings in these autonomous factors. As reserves continue to decline, they will eventually reach their efficient and effective level, at which point we'll resume asset purchases to maintain that level, keeping up with nominal growth. Even at that point, though, we will not be normalization accomplished, though we will be normalization adjacent, because the next natural step in the balance sheet discussion is its composition. Once the balance sheet holdings do not exceed the need, they're unlikely to meet the want, at least not that of the long run. The FOMC has made clear that the portfolio will consist primarily of treasuries, but currently Mortgage-backed securities, MBS, account for more than 40% of our asset holdings. There are no treasury bills, and our treasury holdings have a substantially longer remaining maturity than outstanding treasury securities. While a significant number of treasuries will reach maturity in the coming years, a sizable share has a remaining lifetime of 20 years or more. So we have a kind of barbell structure to our holdings. As we discuss the question of composition, it's worth returning to the Rosetta Stone of policy speak, particularly when we talk about the longer run. This transition of the balance sheet could easily take close to a decade, even if economic and financial conditions unfold as expected. Balance sheet policies are inherently asymmetrical. That is, they are deployed when we need more accommodation than rates alone can deliver, never the other way around. So the portfolio composition will never average normal, nor in fact will it be normal on anything like a regular basis. While the longer run can be something of an amorphous concept, the near term is more concrete and poses pressing questions. There will need to be decisions about how to distribute reinvestments and eventually outright asset purchases when we again start asset purchases. Importantly, those decisions can have an immediate impact and will need to be communicated clearly, as they will almost certainly be the subject of intense market attention. Now, I'm not going to weigh in on the functions, but I will say something about the philosophy. For me, any discussion of composition has to be predicated on a set of grounding principles. While there are certainly more than two, these two to consider, I think, are really important. And I would start with these two, the doctrines of neutrality and flexibility. Neutrality is grounded in the monetary policy makers' Hippocratic oath of doing no harm. In this case, our plans should avoid market disruptions. One way to do that is ensuring that we spread holdings and purchases across maturities in proportion to their amount outstanding, avoiding cornering any one particular issue. In particular, recently issued treasuries, often referred to as on the run, are vital to market functioning. Flexibility, the second grounding principle, is the crucial ability to dip into our arsenal of balance sheet policies if the need arises. And I want to stress that we would only revisit those options if we again found ourselves in a situation that called for more accommodation than the Fed funds rate could provide on its own. But it is important to maintain that ability. One way to increase flexibility is by changing the maturity of the balance sheet's composition. The shorter the duration of the portfolio, the larger the flow of maturing proceeds at any given time. That flow can be redirected, allowing for a swift change in the composition without expanding the balance sheet or having to sell assets outright. One option, therefore, would be tilting the treasury portfolio toward a somewhat shorter term. That can be done by simply increasing our holdings of treasury bills, which have a maturity of a year or less. It's important to note, though, that there are many discussions still to be had, and that these principles are just two of many principles you can consider. Important ones, but they are in good company. Finally, it's worth repeating that the normalization process, while an important policy decision, is not indicative of our monetary policy stance. So I come to the beginning of the end of my remarks. We're on the path to normalization, though when this next step is complete, there will still be more to take. The conversations will continue, particularly about composition, and for me, the principles of neutrality and flexibility will be key. With that, let me end my remarks and open up the floor to questions you might have. All right, I think there are microphones somewhere. We're going to call on folks, Stuart?
Any questions?
All right, Joe.
In the back.
We're coming.
No, Vivek.
Hi, Erin Arvin from the Philadelphia Inquirer.
Great.
Could you tell us the talk recently about the infrastructure program that might be coming down from Congress? Do you anticipate that might have some kind of effect on inflation?
So at this point, the only comment I can make is, given how little detail there is about such a plan, it's hard to put that into an economic model right now to say, right? Because it's very, I mean, we're at the 50,000 foot level right now. We've not gotten anywhere close to any level of specificity and detail. That said, I think there is a broader issue, not about that particular bill, but about a broader issue of the appropriate investments in the productive capacity of our economy, right? And that's not a decision for obviously the Fed to make, that's a decision for fiscal policymakers to make. But it's clear that infrastructure is part of that productive capacity, along with workforce development and workforce training and education, a host of other things that could add to that productive capacity. So I would be supportive of adding that capacity because it would just help the economy overall and help us raise our productivity levels. The specifics of this bill, there are no specifics right now, it's just a concept. But I think in concept, that idea makes sense. I mean, the American Society of Civil Engineers, annually puts out their report of the state of infrastructure in America, not just roads, but water systems and wastewater treatment facilities. We are falling behind. I mean, we're not replacing the capital we currently have. So I think there is a strong case. Exactly how that happens, that's outside the wheelhouse of the Fed. But thank you.
President Harker, thanks for coming here. I'm a freshman here at Drexel.
Great.
And I had a question like, if there's a downturn before normalization, are we going to see QE4 or are we going to see a new experiment just like in 08, whether it be helicopter money or the Fed buying stocks or something?
Are you sure you're a freshman? That's a really good question. Yeah, so the goal, one of the issues that comes up a lot is we don't have a lot of policy space right now given where the Fed funds rate is. Because typically we would, in a recession, and we're not talking about the Great Recession, but a moderate recession, we would take rates down 4 or 5-ish%. We don't have that. So one of the arguments is, well, we should create policy space by increasing rates. But that's a bad idea in my mind, because if you want to run the natural experiment to see what we do in a recession, that's the best way of running that natural experiment, right? So let's take rates up to create a recession and see how it goes. That's not a good idea, right? I mean, nobody wants to do that. So we want to do, again, this gets back to our Hippocratic oath, do no harm. We can only take rates to where the economy is going to take them, right, to neutral. And we're closer, near neutral right now. That's why I don't think we're seeing a lot more rate increases going forward. So if we did have a moderate to severe recession, what would we do? I think we would have to consider the range of tools, starting with one of the arguments about QE was not so much what we bought, although there's been an active debate within the academic literature on that. But its biggest impact was that we signaled with commitment we were going to keep rates low for long. Right? So it was less that the particular assets we purchased, but it was that we committed to staying near zero for a long time. And that forward guidance seems to be the primary, at least the literature to date, would say that it's the primary channel by which QE works. But there's a combination of things, right? You could have QE, you could have maturity extension or Operation Twist, and that's again why I was talking about the balance sheet, if moving it back to a shorter duration so you buy yourself the option. There, that evidence is, at least in my mind, a little less clear how effective that was relative to QE. I think it would be, again, I'm only speaking for myself, right? I think it would be a stretch for us to think about buying other asset classes like stocks. Because I think, again, go back to neutrality, do no harm. I don't think we as a Fed should be in a position of intervening in those markets. Now, that said, nobody can ever say never, but there would be an extremely high bar for me before I'd ever consider such an option. So thank you. Yes? maybe right up front here.
Thank you. I was curious to know if you would see China's Belt and Road Initiative and its Asian Development Bank as a dark cloud or a new beginning.
Yeah, that's a really good question. So there's no question that China has become our major economic collaborator, competitor. I mean, I think we can be both, right? I mean, there's no reason to see the world as binary, right? And that investment is a significant investment, as the recent articles have shown, though there's some tension around that. But again, what is happening is China is spurring other nations and working with other nations to increase this productive capacity of those economies over time. That's a good thing for the global economy. I mean, it's hard to say that's a bad thing for the global economy. However, what it means for us, when I put us back in the U.S. And look at this issue through the U.S. lens, it means we have to be doing the same thing for our own economy, right? And that means both adding the productive capacity we have here in this country, as well as continuing to have good, productive, cooperative relationships with other nations around the world. Because we don't, and other nations do that, I think we will lose in the long run. So I think it's important for us to continue to be open to those productive and fair relationships with other nations, as well as improving the productive capacity of our own economy.
One more.
Thank you. Perhaps returning to the topic of trade that we were discussing earlier in the morning, I'm sorry, I should say I'm Jonathan Doe from Villanova University. Thank you for your comments. We've seen a series of tweets, mostly, threats, imposition of tariffs, and then market reactions to them. And then typically the market then, in some ways, mitigating its reaction or overreaction. In fact, we're seeing it this morning with the, at least, reported breakdown in U.S.-China trade negotiations. The Fed released a statement some weeks or months back saying that it had some concerns about the imposition of tariffs and trade tensions around the world more generally.
Yeah.
I wonder what your current view is about those tensions and whether they pose a real threat to the overall economy or whether we're simply going to have to get used to this kind of back and forth, the threat of imposition of tariffs, the imposition of tariffs, and then kind of a correction back to normalcy.
So let me start with a sort of broader umbrella and then come back to the trade issue specifically. Through our outreach to key market participants and business leaders, both in terms of just one-on-one meetings plus our survey work, we put out our manufacturing and non-manufacturing business outlook surveys. We ask these questions. The headline issue that companies are dealing with right now is just the level of uncertainty, policy uncertainty broadly. Trade is just one component of that, but it's policy uncertainty, and uncertainty in a boardroom is not a good thing, right? Because if I'm at a chemical manufacturer and I'm going to make a multi-billion-dollar investment in a plant, and given this uncertainty, I'll just put it off for a while. I mean, it doesn't make any sense for you to make that decision now. You're seeing that, I think, in certain sectors of our economy right now, that people are just waiting to see the dust settle on not just this issue, but a host of issues. I mean, you take this market here, Philadelphia. We're a market that is heavily invested in eds and meds, particularly the meds. Policy uncertainty around healthcare weighs on those decisions as well. And so it's just a broad umbrella of uncertainty. And what I hear repeatedly from people is, please just leave everything alone for a while. Right? And let us just absorb the changes that have already come in place and figure out how to deal with it. Look, I think there's no question, sort of economics 101, the kind of trade barriers we're putting up in tariffs, while there may be some short-term benefit for certain industries, it's not a healthy thing for the economy overall. That said, we do want fair trade. I mean, I think there's clearly that question. And so I take this all right now with a grain of salt. There's a lot of tension. We don't know how this is going to resolve right now. And so I think we the way I think of this in terms of policy is being a wait-and-see attitude. Let's see some of this resolve itself. That's not unlike what I think is happening in boardrooms all across the country, where people are just waiting to see how this turns out. I think we're in the same situation, because this is not in our wheelhouse. We have to see this through the lens of how it affects the U.S. economy over time. We're not sure. I mean, so we'll just see.
Thank you.
That's it? Okay.
Thank you
Thanks,
very
sir.
much. We appreciate it.